Afternoon. Those of you who don't know me, my name is Jacob Dienelt. I'm the Managing Director of the Digital Asset Group, which is a subset of Brian Kelly Capital Management. If you're aware, Brian Kelly is a media pundit. He runs a global macro hedge fund, and he's on a show called Fast Money 3 times a week, which comes on at 5 o'clock in the evening after the markets have closed to discuss whatever fast money trades were made that day. He's primarily, and his background is as a currency trader, got super interested in Bitcoin a while ago, wrote a book called The Bitcoin Big Bang, and we talked for about a year before forming the Digital Asset Group, which is a digital asset group, where we, as a group, manage digital assets. So, the topic of the speech is finding projects with substance and essentially institutional grade due diligence. So I'd like to start out by saying if anybody has any ideas on how to do that, I'd be really open to hearing them. I'm going to talk briefly about sort of like the equities and the companies at first, because in order to do any kind of sort of sentimental analysis of whatever tokens, be they perfected securities interest in the equity or just a thing that's a thing, it's good to first start looking at the project. And if it's a blockchain token, the first thing we need to look at is, should there be a blockchain? Corda, R3, recently said, yeah, we're not going to use a blockchain because we don't need it. So they've essentially asked for $150 million for Postgres, which is great if they can get it. Not sure, but that's the idea here. Do you use a blockchain where a shared ledger will work? I mean, we've been able to share SQL for a while, and with teacher learner, blockchains are about eliminating trust, and there's a lot of discussion about like the banking sector in this track, and banks trust each other. When Goldman Sachs extends Morgan Stanley $50 billion a day in the intraday credit, that's some level of trust. It's proven that sometimes it doesn't work, but then other people come provide the liquidity and make it work. So the first thing that we look at when we're looking at a picture holistically is, who's the team? Who have they got? Who are their connections? You can look at sort of like some of the earlier San Francisco efforts at putting together like the big companies. And what I like to do is compare TradeHill to Coinbase. And TradeHill had fantastic tech. They were operating profitably. They were generating a tremendous amount of revenue, and they were doing really well. And then one day, the credit union that was banking them got a call from the bank that was banking the credit union, and they said, hey, the Fed called and said, if you don't shut TradeHill down today, we're going to pull your banking license. So that was the end of TradeHill. Then you have Coinbase, which isn't necessarily dramatically superior technology, but Fred Wilson has a great relationship with Silicon Valley Bank. So that works. You have the team, you have the people. Are they experienced? Do they have? Are they flexible? Are they willing to adapt to the different changes that are happening? Because let's face it, like what even the term blockchain means is up for debate. I kind of think we're going to just eventually figure out some sort of shared ledger and then retroactively say that that's what blockchain was. So it's not really that relevant. For investing, however, something that is very relevant, not so much for me as the investor, but as the seller of the tokens, the investees. Investees. Something that's extraordinarily important is the Howey test. And I'm not sure how many of you are aware of what it is. I was at a dinner with a certain unnamed project called Tezos the other day, where their lawyer asked me what the Howey test was, which scared the shit out of me, because the Howey test is what determines if what you're buying is an investment product. So we're at a point right now in the due diligence process where we don't know if what we're buying are investments or not. So for institutional due diligence, that's difficult. This is definitely a very key point. Can the project be integrated into what exists? Because if your fundamental premise is, I've got a better way of doing banking than you do, then you're like 5,000 years too late. We're not going to start again. We actually did an experiment with like burn it down and start over. It was called Lehman Brothers, and it was a complete fucking disaster, and we're never going to do that again. Barclays is still paying out capital on bonds that they're not sure what they are, what the income's supposed to come from. It's just easier to pay it out and move on. Sort of trying to like open up Wall Street and put it on a blockchain, like should scare the shit out of all of you, because it means your ATMs will stop working. Like we don't want to know the truth. So, can it integrate into the existing framework, and can it make a marginal difference that helps going forward? So that's where I'm going to stop the slides, because some of the stuff I'm going to talk about isn't necessarily stuff that I want people to have pictures of. We have essentially decided that we can't invest in these companies. Like we have out of a fund that is significantly larger than this, we have two individual $25,000 equity investments, which we wrote off the memo, wrote the checks, because we made those investments in order to get better access to the ICO. Like whatever happens to the equity of these companies, I'm not even sure whether we are getting more equity in the ICO or not. And again, this gets to a real fundamental problem with doing institutional due diligence, because you can't. Okay, you can't know if you have a perfected securities interest in a asset that's an equity. Do you have a chit against future computational power? Like it is made safe or factum or whatever. These are chits. These are things that you can trade in to do something later. And are you now speculating on what the cost of running this software will be, or what the alternative way to do it will be? I mean, there's a lot of things that go into trying to analyze the value of these things. Now, since you really can't give an answer, I can't give you a discounted cash flow analysis on something that doesn't have any cash flow, and also the discount rate's zero, so it's like the equation ends up being null-defined infinity. You have to look at sort of what is the potential and what is coming in. So beyond anything, and I shouldn't have blurted out the thing about NXT, but Ethereum is really the project that got everybody really focused on what's going on. And that's because if you put $600 into Ethereum, at one point you had 40 grand. Okay, and so Bitcoin is cool because if you put $3 in it at one point, you have 5 million. But nobody did that, except
Roger Ver.
Yeah, no, they were already up. He just already had millions of dollars. But so we do have analytics that we use. We do have algorithms we've created. We have a notationally available Bitcoin sorry, I can't say this right. Institutorial telectics model, which NABIT, which allows us to use something that's akin to Metcalfe's law, which is a valuation metric for lack of a better term, communication networks, which is what Bitcoin is. It's a communication network. You're communicating value. You're communicating whatever you're communicating. And so we use NABIT, the results of NABIT, and we compare that with US dollar available transactional data and exchange transactional data. And our algorithm right now gives a price of about $970 fair value for Bitcoin. So, I mean, within Bitcoin volatility, we're pretty damn close. I mean, you know, 2013, I think the realized volatility on Bitcoin was like, what was it, like 2% an hour? Like, you know, it's something out of control, and there's no way that you're going to get an accurate pricing model at this point that's going to really predict what happens, because, you know, what's the price of Bitcoin? Well, at some points, it's whatever Roger Ver decides it is. You know, like, you know, people can move assets, people can do things, and this is particularly true in the altcoin market. People can just push assets where they want them. I mean, we all have seen, you know, somebody talking about the Telegram chats, and, you know, you can't tell who's telling the truth, what their motivation is. There's this guy, Heleno, he's like I think he's an engineering, like TA, like a PhD candidate at some school in Belgium. And I'm pretty sure this guy's made like 4,000 Bitcoins by like trolling altcoin slacks and convincing people to buy and sell with like 3 different sock puppet accounts in it and just having fun. So, I mean, I can't do institutional grade due diligence on that and explain it to an investor, because what is due diligence? What do I have to do? Well, I have to provide the amount of diligent study and information that is due to the people that are giving me money, their money to invest. Okay, it's due diligence, it's diligence that's due. And to do that, I can do things like this, like Nabbit with Metcalf, and I can come up with a valuation that we can relatively credibly say this is what we believe. This is what we believe based on the models that we're using. But let's be honest, the models that we're using, they turn out to be somewhat predictive, but we didn't start with a predictive model. We started with like a retro fitting of, let's find a model that works for what's happened so far and see if that works going forward. It's kind of like the Laffer curve in economic, like some sort of like economic concept that like we just kind of made up because we needed an economic concept. I mean, economics itself as a science is about as old as chemistry was when they were figuring out water puts out fire. And Wall Street bases almost all of their analysis on Benioff calculus, which is wrong. So like there is no completely credible institutional due diligence that you're right. And what I say about the Benioff calculus, the example is commercial paper issued by, say, Ford. Ford issues 2 types of commercial paper: asset-backed, meaning receivables for cars they've sold, and credit-backed, based on their name. And Wall Street trades those essentially pari passu, like they're the same thing. And in the sense of the outcome, they're correct. I mean, Ford's gonna pay off both commercial papers. But if you look at the variations in like the C and D tranches of these issuances, like there's crazy differentials that happen during, as theta decays in the life of the product. But this kind of analysis is possible on something like Ford Motor Credit commercial paper, because like we've spent huge amounts of money building up analytics tools to do it. And like, we definitely haven't done that with Bitcoin. Like, there's some people that have tried to do it, but there hasn't been like, there's no FMUs. Okay, so DTCC is Depository Trust Clearing Corporation. That's a whole clusterfuck of things Bitcoin should fix, blockchain should fix anyway, because it's 500 million lines of COBOL, and they actually own title to all the stock in the country, which is a little scary. But they've done a pretty damn good job of settling trades. They've got 5 redundant systems in 5 different geographies that kick on with a 2-second lag if there's a problem. And they don't make money. They have revenue, but they're owned by the banks, and they've been adopted as what's called an FMU, or a financial market utility, which means that the banks that use them put in the capital required at the ratio which they use them, and they receive the revenue at the ratio, and it generally is very close to always being you get out what you put in plus the service. There's no, I mean, Brave New Coin and a few other people have put together a Bitcoin pricing index. That's as close as we have to FMUs in this space. So going back to what we were talking about the slides, and so a little just quick about what we're doing. I'm the managing director of this fund. Brian has been running a global macro hedge fund for years. He's primarily a currency trader. He's very diligent in making sure that his due diligence, which essentially means his ability to explain why he did something to investors, is very thorough. And he and I talked for a while, and we wanted to start this fund, and we did. And we've run into the problem that it's really hard to come up with a level of viably explainable due diligence that doesn't make you look like a complete idiot if you get it wrong. So like, I can run the hedge fund and basically be 100% in Bitcoin and then trade euros against dollars to try to get 250 basis points of outperformance against Bitcoin. And if I do that credibly for 5 years, and if somehow like the Little Rock Teachers Pension Fund starts putting money, like if real stodgy, old, boring money starts coming in, then I'm gonna get some of those assets. Most of them go to an ETF, but an active manager that beats will get part of it. And so for us, the level of due diligence required is what do we have to do to be able to tell our investors this is our plan to outperform, okay? Now, it's an interesting game because no matter what you tell investors and no matter what your docs say, everybody's an absolute return fund because, we want to make money. So like, if you're benchmarked versus the S&P and the S&P's down 20% and you're down 15%, you had a good year, but like, not like a great one. If you were up 20% when the S&P's down 20%, you had a great year. You might have a problem with how you're allocated or who's allocated in your fund because they want something closer to the index or whatever. But to create a outperforming index isn't that difficult as long as you can stay close to home. I've got just a minute, but the primary ways that we're, what's up?
Just
if someone has questions for
Yeah,
Jacob.
one minute before we take questions. The primary methodology that we're using to generate this alpha is one, a fiat strategy. So basically saying, I would rather be long Bitcoins in British pounds. Nope, now I've switched to I'd rather be long Bitcoin in yen. Nope, now in dollars. Back and forth like that. And then we are going through the analysis process that I talked about earlier to try to find projects that we're very interested in. And there's one that I'll highlight, which is Cosmos. Cosmos is one of the new proof of stake networks, and I can't remember who said it. Proof of stake is the new black. Like it's a way of distributing consensus that doesn't burn like $60 million worth of electricity a day, so it has some merit. Ethereum's planning to be on it. The BitShares graphene process is one of them. Tendermint, which is the consensus algorithm behind Cosmos, is one of them. And we were able to quickly make the decision we did the pre-ICO funding for Cosmos. And we were able to very quickly come to the level of due diligence required to do that because at the last 2 companies I'd worked for, I tried to buy it. So I'd already done a tremendous amount of due diligence to know, that their product resembles IBM Kix, which is, IBM Kix is the foundation of their Financial Information Services Group, which is like 25% of their revenue. And Kix itself is a mainframe transaction processing. It's a transaction processing mainframe that was developed in like 1960 something and still processes like 98% of all the transactions in the world. And the output looks like oddly like a blockchain. I mean, not with distributed consensus and cryptographic signing, but it's a series of larger transaction batches. They were looking at Tendermint. Tendermint throttles very fast. It's got the same essential delegated bonded proof of stake validation system that most of the networks have. And we think that they have a very, very elegant solution to blockchain interoperability by doing a sort of zones and hubs where you have one real expensive zone that validates all the two-way pegs of the other zones, sort of like the idea of merge mining Bitcoin to make sidechains work or whatever. But again, the other part of why we picked this deal is because having known the team and knowing what they're doing, we know that they're dramatically undervaluing their ICO, so we feel relatively safe buying it. I do think that there's a lot of concern that needs to be dealt with and a lot of reality that at some point is going to catch up with the ICO space in terms of what are these products being sold, what are you telling investors, what's happening. But two things. One, as long as, you know, Ethereum turned $600 into $40,000. There were so few injured parties that no one gave a shit about the DAO. Okay, and so no injured parties is a big one, and then being the buyer, not the seller, is another good way to protect yourself from liabilities from selling. So true institutional grade due diligence in cryptographic investments is really, the answer is really how much diligence do your investors demand, because that's how much is due.
Just a quick question.
Hi.
When managing a large portfolio in a market that is actually quite volatile, how do you approach risk management, especially when the altcoins are correlated?
Okay, yeah, right. So, well, correlation is a whole. It turns out. So we had this raging debate for like 2 days about, Mike and I were talking to Brian. I was like, no, dude, like Bitcoin going up doesn't mean alt's going down. Like it's not the same, but that's because we were looking at the correlation of both priced in dollars. Like if you look at one priced in the other, they definitely correlate. But Bitcoin itself is the most non-correlated asset with significant performance that I've ever seen. It's up like 300 or 400% with zero statistically relevant correlation to any other asset class other than a 7%, 5% is the threshold, a 7% correlation to the Vanguard real estate ETF, which I mean, I kind of think is noise. I mean, maybe like, I know there was that Bitcoin Premier thing. Barry Silbert's brother was trying to sell real estate for Bitcoin. Maybe he got in with Vanguard, I don't know, but it doesn't seem like there's any correlation. And to answer your question more directly, it's a real nightmare. We have a really, really hard time deploying money. Most of what we do, okay, so well, when we began, from the benchmark beginning of the portfolio, it was 96% Bitcoin. It's now much less. I mean, it's still the vast majority, but it's much less. But that has nothing to do with us selling Bitcoin and a lot to do with other people buying Monero. So we had an allocation of Monero that was small and is now like really scary because it's big. I mean, I actually think Monero's probably got another 500% in it, but I have to sell a max withdrawal from Poloniex every day because I'm over my risk levels. Like I'm not allowed to have as much money on Poloniex as I do. Our threat modeling is well under $1 million for Poloniex. The highest two custodians our threat models give are Gemini and ItBit because they have trust charters, followed closely by Kraken and Stamp. I mean, Stamp has stood up and, you know, Dan Moore Pantera put $10 million into it when they got hacked. Like that's kind of like being a stand-up dude and backing up what you're doing. So there's some comfort there. I personally like Kraken because I know Jesse Powell and Ifu, and I trust them both very much. So that's where I want to trade, but I can't. The majority of my trading has to go through Gemini and through ItBit. And frankly, the majority of my trading goes through mini primes in traditional Wall Street because it's mostly fiat. It's mostly switching what fiat we're denominating Bitcoin in, because the Bitcoin that the vast majority of the Bitcoin we bought is in like as convoluted and as complicated a custody situation as we could possibly figure out how to do, because that's definitely the biggest problem is custody. Because, you know, like everybody's Bitcoins get stolen or lost or something, and that's a fucking nightmare, and, you know, really not something you can explain to an investor. So the most of our investment in Bitcoin is locked away. And we do definitely trade on Poloniex, we trade on BitMEX, we trade on Kraken, we have some white label stuff worked out with some of them because we know them and we can move larger amounts of money, not in Bitcoin, but in the native currency. Like, and sometimes it's like a real problem. So if you have, I'll throw a number out there, it's not the number, but let's say I have a $500,000 threat model allowance for Poloniex, and I put like $60,000 into, I don't know, blueberries or whatever that coin is called, and it goes up like 900%. All of a sudden I have to start liquidating my other coins to get the money off the exchange. So it's, I mean, it's really, really the Wild West. And being sort of one of the pioneering, and I'm not trying to be too self-aggrandizing, but like being one of the first institutional grade hedge funds to do this, like, well, the required level of due diligence is whatever I say it is, and whatever my investors are cool with. So how much can I keep on Poloniex? We've done threat models. Got a guy named Mike Sofair who works with us, who's probably one of the less known but more brilliant people in the space, and his main job is to tell me no to stuff. So, you know, we put as much on as we can, and are constantly in a position where I've been told I have 14 days to get the amount of money at Poloniex back under the threshold, which I can't do withdrawing $25,000 a day unless I sell and crash a coin. You know, so, yeah.
I'm just curious, roughly, what's the likelihood or in your world, what's the likelihood of an exchange failing? For example, Poloniex.
All right, so what's the likelihood of an exchange?
1%, 5%, 10%, just the range.
Much higher than 1 or 5%. So, okay, what does it mean though? What happens when an exchange fails? What happened at Bitfinex? They got hacked, and then they created a whole new conceptual product, a debt token that was a non-perfected securities interest backed by something that might happen, and like everyone was like, sweet dude, Phil Powder's got it, like let's do it. And it worked. And like I can't explain that. I can't go to Metropolitan Capital. I can't go to a big hedge fund and be like, listen, it's okay.
We got this.
We have this new thing. But you know what? That's what they want. Like Bitcoin went from, you know, like pizza to $1 million because it's a new thing that did. And so people like, what backs all of this, despite the ability to maybe stand up and credibly argue to like a real belt and suspenders kind of guy, like why this fundamentally makes sense. It's like, because dude, there's like so much money trying to buy it. And so it doesn't really matter what it is. Like if there are more dollars going into something than there's an available supply to sell it, it goes up.
Okay,
Yep.
Jacob, I think this is the last question for you,
Sure.
please.
What's your opinion on the Wake and Ball CTI?
Good question.
Do it. Like, you know, look, we're trying to be an institutional, I'll answer what I want and then what I think quickly. We're trying to be an institutional alpha generating money manager in the space. For credible institutional money to come in, for CalPERS to ever put money in, there's gotta be a passive asset. Okay, there's got to be a way for them to just buy Bitcoin with good custody. That's what coin is. And I had been completely sure, I mean, almost as sure as I was when I bet $20,000 on Hillary Clinton, that there was no way that this ETF was ever going to get approved. But ETFs don't have to get approved, they have to get not rejected. And we're getting real close to the no action date, and like maybe even just the letter doesn't get in the mail, but like we might have a Bitcoin ETF. Woo later, because a lot of ETFs and a lot of like this feels, look, we have a current Metcalf, you know, our equation, Nabit puts it at 790. We're more than willing to hold much higher than 790 because primarily we need to beat Bitcoin, so we're going to hold Bitcoin. The Bitcoin ETFs are custody solutions. They are institutional in and out custody solutions. I think it might happen. I'm shocked by that. I am super jazzed about it. Because if that happens, then my 2 and 20 part is going to get much bigger in a couple of years. Because like, if I can outperform by like, I mean like 100 basis points, like 1%, like there'll be huge capital flow into it at some point. And that's, you know, ultimately what I'm trying to do is, you know, I tell people, you know, I'm a Bitcoin believer. You know, I've got the white paper and the Constitution in my pocket, right? Oh. But you know what I like more than Bitcoin? $100 bills. I mean, I'd rather have one Bitcoin than one $100 bill. But like, my favorite thing to collect is treasury bills. Like, I like to have a nice big collection of money that can be printed to pay me back. Like, so
Thank you, Jacob.
That was a terrible way to finish it.